name is Emily Foshag, and I'm the portfolio manager in charge of our listed infrastructure strategies here at Principal. The return drivers and fundamentals of listed infrastructure and private infrastructure are very similar, and the long-term investment returns from both listed and private infrastructure have been roughly comparable. Whether you're discussing listed or private infrastructure, traditional infrastructure assets typically offer specific attributes that support the delivery of steady investment returns throughout an economic cycle. These businesses provide services that are essential to the functioning of our societies and operate under regulated or contracted revenue schemes that provide investors a high degree of revenue and cash flow visibility. Income is also an important component of investor returns, which really contributes to the stability of the investment proposition. The main justification we hear from institutional investors regarding the preference for private infrastructure over listed is really that you typically have lower volatility ascribed to private infrastructure. In our experience, the inherent lag and smoothing effects that are typically inherent in private market return indices are really the main driver of lower volatility associated with private market indices. This is best demonstrated when you compare the volatility of public market asset classes with their private market counterparts. So take private equity versus global equity, or private equity real estate versus listed real estate, or listed infrastructure versus private infrastructure. And typically, the public market opportunity is around 2 times the volatility of the private market counterpart. It's also really interesting if you look, for example, at private equity venture capital, the volatility of those returns. I think we can all agree that private equity venture capital is probably a high risk return proposition, but the volatility associated with venture capital returns really is only a couple of percentage points higher than private equity infrastructure. And so what it really comes down to is that probably volatility is not the best measure of risk when you're comparing public and private market investment options. Ultimately, we believe it really doesn't have to be either or when it comes to private versus listed infrastructure, and that's important. Listed infrastructure has the potential to serve a variety of complementary roles as part of an overall infrastructure allocation. We see an opportunity for listed infrastructure to be used as part of an infrastructure portfolio completion strategy to preserve liquidity and to help investors gain immediate exposure to the asset class. In terms of portfolio completion, we see some sizable differences in the opportunity sets from a geographic and sector standpoint when comparing listed versus private options. You also have an opportunity with listed infrastructure to introduce diversified exposure when it comes to the company level, stage of development, and also to businesses where scale matters. This point about stage of development is particularly timely. Most private strategies focus on operational or brownfield infrastructure, assets with relatively minor capital investment requirements. Publicly traded infrastructure companies, in contrast, are typically heavy deployers of capital and really looking to grow the asset bases in their different service territories. And what this means then is if you read the policy headlines that are out there, for example, policy support, renewable energy, green hydrogen, biofuels, all of that policy support is really designed to support developers. And the vast majority of development is taking place within listed infrastructure companies rather than within private infrastructure strategies. The coronavirus pandemic has been an example of an opportunity for investors in listed markets specifically, with the fundamentals of transportation infrastructure drastically changed during periods of lockdowns and intense mobility restrictions. That often led public equity markets to really sell these stocks off. And so you had an opportunity to buy attractive, high quality businesses at pretty attractive valuations. Private equity investors also noticed this, and so you saw an acceleration in take private activity over the last 18 months, really again taking advantage of that valuation dislocation in the public markets. Maintaining some degree of listed infrastructure exposure also allows an investor to maintain a desired asset class exposure, even when they're waiting for capital to be called for deployment in a private equity strategy. This point is particularly relevant when you're thinking about private equity infrastructure dry powder held at funds being at all-time highs today. As regulated monopolies or monopoly-like businesses delivering essential services, most listed infrastructure companies have a differentiated potential to preserve margins when inflation is rising. Frankly, this doesn't only refer to periods of higher inflation, it's also about their ability to preserve margins regardless of what's going on in the macroeconomic environment. And that defensiveness throughout a macroeconomic cycle is really a key selling point of this asset class exposure. We've historically seen that listed infrastructure has outperformed during periods of rising inflation. This suggests that structural advantages that these businesses enjoy can in fact translate into attractive relative stock price performance during periods of higher inflation. Listed infrastructure companies also have a strong track record of delivering income growth that outpaces inflation. Beyond the broadly positive positioning of listed infrastructure companies, the nature and degree of inflation protection can vary from a bottom-up perspective depending on the company, the geography, the sector, etc. And so active listed infrastructure managers really have an opportunity to position portfolios towards businesses that have better protections when folks are worried about inflation as a potential negative impact for this sector. We believe listed infrastructure businesses are uniquely positioned at the intersection of social, environmental, and economic progress. Infrastructure has a huge role to play when it comes to contributions to the UN Sustainable Development Goals. For example, infrastructure companies should be able to contribute to over 2/3 of the underlying targets. We also see listed infrastructure companies as absolutely critical to the clean energy transition. The opportunity for Scope 1 and Scope 2 carbon emissions reductions for listed infrastructure is more pronounced than for almost any other sector or set of sectors in the global equity universe. Most listed infrastructure teams are made up of dedicated infrastructure specialists, and we think this can really be an advantage when it comes to increasing expectations for engagement with company management teams, and also being able to demonstrate to our clients the outcomes associated with those engagements. We find that company management teams are generally more likely to respond to constructive dialogue if there's a prior relationship that exists, and frankly, they trust that you understand the challenges inherent as they try to balance often competing needs from their stakeholders across both social and environmental objectives. It's important to keep in mind that listed infrastructure companies typically represent only around 5% of global equity indices. In addition, generalist investment managers are increasingly adopting structural underweights to the more carbon-intensive industries as the basis for their ESG credentials. Listed infrastructure companies may be even less represented, therefore, in global equity allocations going forward. So targeted allocations to listed infrastructure may be necessary for clients that are looking to maintain exposure to this compelling opportunity.